Wow, what a crowd we have for the last session of day 2 of the Singapore FinTech Festival. I mean, thank you all for being here. We've been having this conversation on digital currencies across a few years, of Singapore FinTech Festival, as well as the Point Zero Forum. But we've come back today with a brand new format where you'll get to see your favorite people spin the wheel, take your questions, and answer them on the spot. I'm pleased to introduce to you and welcome to this session, people whose first names are household names. They don't need last names. But we have Dante Desparte, Chief Strategy Officer and Head of Global Policy at Circle. Round of applause, please.
Thank you.
We have Renee Michaud, Global Head, Digital Assets, Standard Chartered. And we have Umar Farouk, Co-Head of Global Payments at JP Morgan. Please welcome him.
Well, see, I brought people.
Well, everyone has brought their host of fans. Now, let's go to the rules of the game. Now, I'll quickly just explain to you how we're going to do this today. So the wheel features 3 question categories. There's the brain buster one. There's the one that's difficult. Okay, there's ask me anything. That's one from you guys. Okay, and then there's piece of cake, which are the more straightforward ones. But I took a look at the questions. They're not that straightforward. So please don't relax yet. Now each speaker will take a turn to spin the wheel. Right? Other speakers may contribute to that session of 8 minutes per question, but they're not going to get points for that. Of course, you speak to the audience because the audience will eventually be voting for their favorite speaker. And for the first 3 questions, if the wheel lands on Ask Me Anything, say here, we won't be able to take them because we want to give you, the audience, enough time to upvote the most popular question to be answered. Can I have the slide, please, on the QR code? Very great. So please scan the QR code to put in your question, right? Select the session and participate in the pigeonhole because the most popular question will be answered in the second round. So the second round of the 3 questions, if we hit Ask Me Anything, the most popular question will be answered. Now, in the event that the wheel decides and none of you will answer an audience question, Umar has graciously agreed to take an audience question as the final speaker of round 3. Now, all clear? We're all good? Yeah. And audience, at the end, you get to vote for your favorite speaker. The scores will be tabulated all together. Now, without much further ado, may I invite our first contestant, Dante, to come up here to the wheel and take your very first spin.
All right. Let's spin the wheel. Ready?
Gently.
Yeah.
We haven't stress tested the wheel yet, and it looks like it's gonna. Ooh, you get
dear.
Brain buster to start with.
All right.
Okay, can we please bring up that first question, which is from Sujit. Sujit won. This is a very, very auspicious sign, Dante, because Sujit won Best Speaker at PZF, if you remember, at this session. Now, he says, are we heading further and further away from the promised land? We are seeing so many different solutions and ecosystems being rolled out, and that customers, whether individuals or businesses, will find it challenging and confusing to adopt. How can we correct this market failure? Dante, you start first. When you're done, the rest can chime in. Time is yours.
All right. Wonderful. So first of all, it's great to be back. The last time I was here and I was surrounded by these 2 wonderful gentlemen, we won a debate, didn't we? So we hope to leave with the persuasive audience and the ability to vote yet again for a form of money and a form of payments activity that serves you. And that is a product like USDC. And I don't mean that lightly, I mean it seriously. In the span of the 6 years that USDC has been introduced as an always-on form of digital money that doesn't take bank holidays, doesn't ride on closed rails, and that actually works all over the world for little more than a basic internet-connected device, you would say to me, well, Mr. Desparte, this is little more than fancy. And then I would say to you that from 0 to nearly 200 countries, and over the same span of 6 years, this activity has processed more than $17 trillion of always-on, on-chain activity. But for competition, not a single bank in the world, and potentially not a single central bank in the world, would be having a conversation today about how can we make forms of money that serve people better, cheaper, and faster, and most importantly, in a manner that also reflects the internet-scale nature of human need. Your and my financial needs don't take bank holidays, and the forms of money that we should enjoy shouldn't either.
Okay.
Well, Dante, I think well put, and I'll open the floor up to your other two friends here who are raring to go. Uma looks more concerned.
I'm just a bit surprised because I don't know where the answer was, because it was a nice infomercial for USDC, but I thought there was a question. But first of all, I do want to start with I have someone who's in the crypto industry, stablecoin industry, but dressed like a banker. I got a banker who's dressed like a crypto industry person. So I just want to point out I'm the only one dressed for the part that I actually play. So, I should get some points for that. But that being said, I would say that I agree with Dante that, this ecosystem has pushed thought process quite far. But if they want to pay their folks in real money, they still have to come to a bank. And given that we move about 10 trillion every day, we do a circle every day and a half. So, there's that. So that's circle from inception to today. Regardless, coming back to the question, I'm not sure I would call the proliferation of different tokens a market failure. You could call it, an open market. I think we have a problem with consumer protection and regulations around consumer protection, where some of these things, which are not done for a good reason, could be fraud or whatever, need to be taken out of the system. That's not all, that's some. But to some extent, if there are fair, competitive things out there, there's 10,000 plus banks, we all compete with each other, there's no reason why there couldn't be, dozens of different tokens out there, whether they're stable coins or others. As long as they're well regulated, well controlled, they should battle it out. That's not a market failure, that's just the market.
I know, and Renee's just like, but I want to say something too.
No, I got nothing to say. No, I'm kidding.
Yeah.
First of all, wonderful to be back here in Singapore at the Singapore FinTech Festival with two of my favourite people to argue with. My children are the only ones I like to argue with more. What I think is interesting about Sujit's question is evident in my colleagues' answers. If we all continue to push our own solutions and talk about how great each of our individual solutions are, we are heading directly away from the promised land, as Sujit points out. I think I think there's no question, though, that the infrastructure that Circle leverages, the technologies that JP Morgan has used to build similar infrastructure, all of us are looking at those and working out how we can provide a better market. And I agree, I don't think it leads to market failure, but I do think the number one thing here is actually all of us together as an ecosystem, pushing out the bad actors and working on scaling solutions to take complexity out of the financial ecosystem and make the e-commerce and Web3 space work properly and in a way that's safe for people in which to participate.
Yeah, at the previous panel that I was at on QR payments, because today we had two industry solutions launched on interoperable QRs, one of the speakers said that the whole is greater than its sum. And indeed, it speaks to how a collaborative nature would get us, progress us forward more. And to this, Dante, I was just wondering, what are your thoughts a little bit about collaboration when we have market fragmentation here that Sujit talks about?
Yeah. I think, look, there is, by the way, I note with interest that I am dressed like the banker and my colleague is the crypto anarchist who works at the bank. But there is unequivocally a reality that I must confess on the stage, because I think our fierce debate is now olive branches being passed to one another, that crypto may need banks more than banks need crypto. But if every bank had to compete with the digital transformation capabilities of the very biggest banks, and yet if any bank failed, it erodes confidence in all banks, then we need to figure out how to balance this as an ecosystem approach. Regulators talk about activity-based, technology-neutral regulation, but when it has come to regulating tokenization, blockchain, stablecoins, and digital assets, we have not been tech neutral when we hold up our mirror as policymakers or as regulators. And so something has to be done that allows us to allow for same risks, same rules, including the banks. I probably do more to legitimize their activity in this space than they do to legitimize mine, in part because where we go, banks follow, and the partnerships with these types of institutions and many more are a key feature, not a bug.
And with that salty statement, I think we should pause here for this question and take the next one before Uma fires back with the number two. Uma, hold it for a moment. We will have Renee come up next to gently caress the wheel, please. Hasn't gone through any stress testing, you know.
Is that too much?
It is perfect, but it depends on where it ends on. Oh. There's so much suspense and piece of cake for Renee, please. Can we have a slice of cake for Renee coming up on screen in any moment right now? Morgan. Now, Morgan, so all these questions, my friends, came from their peers at the Point Zero Forum debate just this year. So quality is assured, all right? Quality is assured. Now, Morgan has a slightly more straightforward question for you, Renee. What are the real-world pain points and business challenges that digital currencies are solving that payments using traditional rails cannot? So, Renee, time is yours.
No, thank you very much. And it's wonderful to get this question from Morgan. So for those of you who may have been there in Switzerland earlier in the year, Morgan performed a devastating opening directed at me, to which I had to respond. And I'm rather wishing she had asked me this question instead. Yeah. But I think, that that real-world question is really important. There is a lot of innovation happening, a lot of work, a lot of proof of concepts, and a lot of thought being put into what does the future of money look like. But I think we have to step back and go, what's actually working and what actually exists. So large-scale public blockchains have outscaled many of the permissioned blockchain initiatives that have been attempted. We have stablecoins which exist today and have a significant market value. And it's important to think about, well, why is this? Why have we got an Ethereum, Solana, Bitcoin ecosystem scaling to the point that they have? And why are we not seeing the same scale in traditional market infrastructure tokenizing assets? So I think that speaks to the heart of this question, which is what's working? The idea, if you look at 18th and 19th century banking, we saw bearer instruments really accelerate global trade. The idea of being able to freely exchange a promissory note from one party to another in exchange for goods and services was what drove a huge amount of economic and infrastructure expansion globally at that time. And so there's a tendency since the 70s we've had central databases in banks managing the ledgers connected by messaging systems, which also exist and also work. But we tend to make the assumption that banking has always looked like that. And so we tend to look at things like Bitcoin, Ethereum, stablecoins, and large-scale blockchain-based infrastructure through the lens of this accounts-based system. So what are the problems that are being solved? Number one is a single ledger that's globally available and runs 24/7 and isn't closed on bank holidays, as my esteemed colleague mentioned earlier. And also the idea of being able to exchange value person to person directly, which is a claim on a reliable source of value or store of value. And I think those are very, very important fundamental primitives for us to consider as we work through the experiments that we need to build on. That's what's solving very complicated payment challenges. It's helping markets where there's been a retreat from correspondent banking, and there are some really interesting things happening. The only cautionary note I would add is that whenever we have a new technology that expands at scale, obviously we have bad actors. When the internet was first launched, it wasn't all pictures of cats, right? There was quite a lot of nasty stuff happening on the internet, but that scaled. And what we did is we built infrastructure to mitigate the the darker side of humanity, if you wish, to ensure a safer space on the internet for us to do business and for us to exist. And I think we need to do the same thing with money. But overall, those fundamental principles are solving the problems that the traditional rails cannot.
Yeah, Renee, I liked when you talked about promissory note, because here in Singapore, we're about to sunset corporate checks for good. And it was I think, a bold policy move that we were ready to do so. But that's because much of our population, especially our corporates, have moved away to digital means of payments, coming, as you say, as an evolution. And because they have done so, we were then able to say, okay, let's say goodbye to corporate checks. But in the same vein, would we then see a future where we might say goodbye to our traditional rails and leapfrog into that space where it is fully digital? How much of that traditional rail will we leave behind? It's a question I have for Dante and Uma as well.
So I think traditional rails evolve. So, a long time ago, there were different rails, then wires came along, then ACH,
like actual
then
train
RTP.
rails.
Yeah, I mean, now we have, in our Connexus platform, we have rails which are frankly next gen on top of things. Rails continue to evolve, so I think that's one thing. I think there's a little bit of a maybe naivete about how people think about these things, because people like trusting institutions. Okay, they might trust a bank, and primarily banks deal in trust. We exist because people trust. They leave their money with us. When they show up again, they get the same number of dollars, hopefully, in most cases. Now, if you think about crypto, same thing has happened, because yes, there are P2P rails and all of those things, but then there are actual companies that have come in the middle because they provide trust. So, a Circle, you trust Circle, like you don't just go to USDC because you're trusting Circle. Yeah, hence a suit and tie, and that makes it even more trustworthy because you're wearing a tie in SFF. So, but if you are you have essentially, you have Coinbase, you have all these entities. So I think it's less a question of rails, and it's more a question of how do you provide trust in the system to solve problems. I mean, for instance, for us, we solve problems for very large corporates that want to do programmable payments. We learned that, by the way, from the crypto world, because we couldn't get there directly easily. We learned, lifted, and dropped it into an ecosystem that's big enough, and people are doing programmable payments, and they want to pay 24/7 across the world, any quantity. So I do think that happens. The only thing I would say is, you mentioned one thing, which is like the withdrawal of correspondent banking, which kind of connects to, sometimes that withdrawals happen for a reason. So, and we just need to make sure that people are not using a new form of digital currency to essentially evade laws and regulations.
And if I may, Joe, so I love that you're describing the rails, because in so many ways, we've spent the last 5 years in the stablecoin conversation discussing different ways to rebrand the same product. So I would respectfully submit to the audience that a stablecoin by any other name is still a stablecoin. CBDC, a deposit token, a tokenized treasury bill, all have cash-like features and should provide for the holder redemption at par, even in the issuer's distress or bankruptcy. The real breakthrough conversation in payments is the rails. And this is where I completely break free both of the central banking direction of travel and the banking direction of travel, which is that from Agustin Carstens and the BIS, we have described this idea of a finternet. But guess what the structural components of the finternet would be? The same institutions that have had a monopoly on moving money for the better part of 100 years, partnering with each other in institutional permissioned ways. And if you want to create an actual internet of value where trade and trust are not necessarily sacrificed, then you also have to allow this to be a peer-to-peer network-based piece of infrastructure. And at the end, exactly as Renee described it, the first internet was the dark web before it's the web we now enjoy for household and business and economic continuity. The very early prototypes of crypto were also shady activities with shady characters and shadowy supercoders on the internet. And today, there isn't a household institution, from BlackRock to JP Morgan to Standard Chartered and entities in between, that also want to participate and provide their core services on that infrastructure too. And to ban them from participating in open blockchain ledgers would be to ban any institution from using cloud computing. And that, to me, is the most fundamental policy conversation for payments innovations, is if we want money that moves at the speed and scale of human need in the internet itself, we need to then create an internet of value and not an extranet or an intranet. Because all of the rails up until now are both.
Yeah, so open access to all fundamental payment rails is probably the key to better interoperability amongst different types of digital currencies. And on that note, shall we please invite Uma for your spin?
Very, very slightly.
Very slightly, not too slightly though. Well, that was very slightly. Was that what you wanted? Was the brain buster what you wanted?
Yeah, I guess now.
Aiming for the piece of cake.
Okay.
Let's bring up the brain buster question, please. I'm not sure what Uma's intentions were, but I think we have a good question for you from Livia, another friend of ours from the Point Zero Forum debate, right? Livia says, is DeFi able to adapt to create an accountable person? So this ties in with what we were saying just now, right? About accountability, accountable person or entity to satisfy regulatory requirements and have accountability. So I think what Livia is perhaps hinting at here is that in a DeFi world, you might not be able to find these people to take responsibility. Uma, time is yours.
So can I ask a question? I mean, it's a brain buster. Can I call a friend?
You want to call a friend?
Yes, can I call a friend?
I will allow it,
Okay.
but is your friend in the audience?
We'll find
see.
Yeah.
This question was too hard.
I do want to check.
Oh. So,
All right.
Hello, Umar? So
Dante?
it was Umar, but
Yeah.
I'm not going to take his call.
You're not going to take this call? You want to
I'm
call
not taking
another
this call.
friend?
No, I'll try another friend. I think I'll just take the question myself. I mean,
Yes, please.
there's a lot of accountability in this question. There's
is.
multiple accountables, so I'm, want to take it very seriously, the accountability angle. It seems like a bit of an AI question because, can DeFi create a person? So, anyway. So I think the things are a bit different. In reality, if you think about DeFi, it's an interesting concept of automation and, sort of where people can interact without a central authority. So I'm not sure you need to create a person. However, I do think you need to have a lot of accountability and controls around this because in some ways, I think crypto is just, and I think I read it somewhere, or it's quite a common thing. Crypto is learning all the lessons of banking and all the mistakes just really fast. So they're on an accelerated path. They'll probably have a few blow-ups like the one that happened 2 years ago. That's not the last one. There'll be more. And banking has had their blow-up cycles. I think slightly longer cycle, but then crypto is very very quick to learn. So it's more compressed. So as we go through those, the danger in DeFi is creating the same kind of issues that almost have brought banking down a few times, whether it was in the 20s or whether it was in, 20s meaning 1920s, or it was actually in the global financial crisis about 15, 16 years ago, where you start building leverage on leverage on leverage. You take something, you borrow against it, then you put that somewhere else. And I think unless there's governance, not around just one DeFi, but the DeFi ecosystem, you will continue to create these risks in the system that actually possibly can blow up the whole thing. So when you start to unravel, we all know what happened at FTX to some extent, so the same thing can happen again.
Yeah. Please, Dante.
If I may briefly, because I know my friend who's wearing an amazing T-shirt, by the way, that says stablecoin things in the brand of a certain.
Does he think that stablecoin is stranger?
It's pretty cool, but I love it because
stranger stablecoin things.
There you go.
Stranger stablecoin.
But on this question, there's a really important policy issue at play. Right now, we have in a world the presumption of guilt is the way we de-risk financial access on the planet. What DeFi and anonymity and pseudonymity have to presume of crypto finance is the presumption of innocence and the proof of guilt. And this is one of the why law enforcement loves digital assets, all of it, including the totally decentralized kind, is because we leave behind digital breadcrumbs of our behavior. And so I don't need to know Umar's identity to interact with him, but I will know through blockchain-based financial activity everything that ever went into Umar's wallet. And so this presumption of guilt has to change so that we could actually extend the perimeter of financial access to billions of people who have no access to finance in the first place. Now, the best argument for DeFi and the best argument for the total distribution and decentralization of crypto is that, number one, we will address financial inclusion questions that are stubborn and will not be solved if we just keep doing the same thing the same way. The second is that they will promote companion innovations like distributed identity, decentralized identity, verifiable credentials, and the crypto is short form for cryptography. The very thing that you and I will enjoy as background tech that keeps the internet itself safe and banks themselves safe are now in the hands of everyone everywhere, and there's a very, very powerful case for this brain-teasing question.
Yeah, but
So I am going to actually go back because I think no point if you don't have a little bit of debate. So I think that's oversimplifying things. I understand the presumption of innocence. That's the rule of law that we all live under. However, in financial transactions, just because the same drug dealer keeps walking in with a briefcase of cash, you don't know who it is, but you go like, yeah, I've seen this person come in with a briefcase of cash 5 times before. I just don't know who that is. Doesn't really work. So I think we do need stronger KYC rules. Now, again, we need to make sure they are protected, data identity is protected, but just being able to move significant amounts of money cross borders and say, we know from a pseudonymous point of view that that person is okay, especially in the world of tumblers and things, there is a lot of risk that needs to be controlled.
Indeed, but I think where Livia is coming from also is that in DeFi, sorry, stranger, stablecoin things, I will give you a little one more minute. But she's saying that when it is decentralized, for example, it's difficult to pin the regulations upon your institutions as they traditionally would. And coming from a regulatory policy perspective, I have sympathy for this. But stranger stablecoin things, please, go ahead.
Well, first of all, I don't want to address what happens in the branches of JP Morgan. However, what is interesting from my esteemed colleague's perspective is that the founder of JP Morgan was also very interested in owning the rails. Right? Anyone who knows their American history knows that JP Morgan bought the railways in order to make them more efficient. So, but to this question, I think actually the points that Dante was making are very important. But even more importantly than that is the fact that what we're learning on this global ledger context that's difficult to learn within a regulated bank or a single institution is how we might construct new financial services and new ways of doing financial services that can create that level of accountability. If anyone, we don't have time today, but if anyone wants to go deep on this topic, there was actually a presentation to Congress recently. My good friend Rebecca Rettig has authored a paper on the way that we can put structures in place within DeFi to be regulatory compliant and to create accountable persons from a legal context. And that view is absolutely fascinating when we think about how our organizations might be different in the future and how we might build much more effective, complex but safe financial products, as well as how one might leverage infrastructure like that of my colleague on my right to be able to use fiat currencies on that.
Fantastic. So I think that's all the time we have for Section A. Now let's go to Section B, where we hope one of you will hit an audience question. Dante, the wheel is yours again.
Oh dear.
Audience.
The fear is real. Audience.
Like various things that Singapore government creates is too efficient this week. It keeps going, so yeah.
Notice that I gave it a full circle, unlike my banking friend.
Yeah.
No pun intended.
Yeah.
Come on. What type of wheel is this? Okay.
You've got asked me anything.
All right, bring it.
I did not rig the wheel, okay? But well done, Dante, for putting it right on.
There you go.
Ask me anything, so we can put out an audience question.
I fear this wheel may be rigged, just like the traditional financial system.
I have. Oh.
I'm just saying.
But you're the one in the tie.
I know.
Okay. So with 7 votes, DC, where are you? Thank you so much for your question. Can stablecoins, with their one-to-one backing, DC is not a pseudonym for one of my teammates, by the way. So I think it's a real one.
And it is still the capital of the United States of America. Don't fear.
It is still. It is still. Okay, one-to-one backing scale to handle trillions of daily USD transactions at scale. Do they represent a risk to global financial markets? So, for example, crypto-native events reverberating through treasury markets. Dante, I think this is rigged because it's a question that is bang on for you.
Yes, okay, great. Well, first of all, it's a great question. Thank you for asking. Because it also allows me to underscore a really important policy gap in the conversation, which is what are we building with stablecoins when they are regulated? By just a certain point of order, if you are designing a stablecoin today and you choose to not have it regulated, that says a lot about what you're trying to do and who you're trying to serve. But there is no excuse anywhere in the world to not be able to offer these products as regulated solutions, first. But what are we solving for? Question one, would you want a stablecoin or a deposit token issued by a failed bank like SVB in the United States or Credit Suisse? The answer is no, because there's a balance sheet problem in fractional reserve banking. And that's not to impugn the core function that banks deliver, which is credit creation, lending, and all the other core transformations of money. But a stablecoin fundamentally, to be a payment product, has to solve crypto's original sin, which is buyers and spenders remorse in things like Bitcoin Pizza Day. And so the stablecoin has to actually hold reserves very conservatively. The policy gap was that we spent the last 5 years discussing what risk would stablecoins and crypto finance introduce to the real economy and banking, but we never asked what risk would banking introduce to fully reserved stablecoin products. And this is not a joke. As a digital dollar, if the US economy sneezes, Circle catches a cold. And we had 2 examples recently, a round of bank failures, and the second was, of course, the US debt ceiling discussions that even made holding treasuries potentially complicated past the maturity date of the debt ceiling. And so for this to be digital money, it has to solve the buyers and spenders remorse and the hypervolatility of traditional crypto assets, number one. And number two, it has to be guarded in the most safe, sound prudential standards, so much so that it might even put globally systemic financial institutions' prudential risk standards to shame. And that's the critical feature. And so in a world where digital money all becomes exactly the same, the rails, yet again, as we just discussed, will be the breakthrough innovation.
Indeed, Dante, and I have to let Uma go next because, he's been standing like that.
No, I was just admiring Dante's answer. But anyway, I have to say, be careful what you wish for. So, and to my knowledge, actually, I thought Circle banked with SVB, so maybe pick better banks in the future.
Well, because a couple big banks wouldn't let me.
Yeah. So anyway, I think if you think about what is happening in stablecoin regime, I agree. If it's one-to-one backed, by definition, you have lots of liquidity at the back end. However, banks do function, to Dante's point, in various ways. We actually do lend that money out, and commercials can do it. We also, by the way, pay interest on what people leave with us, especially if, holding significant amounts of money for large players, you're actually passing on almost all of what the current interest rate is in the US. That being said, I think if stablecoins wanted to be like banks and said, okay, we are very safe and we want direct access, then they have to also meet the same level of regulation. And I can just assure you, you ain't seeing nothing yet if you want to start building bank level regulations.
Now he's saying, indeed, be careful what you wish for. But on this point, Renee, do you agree, Uma, or are you more on Dante's side?
In the middle.
Yeah, I'm in the middle for a reason, right? Look, I think there's two really interesting questions here. First of all, it doesn't matter about the infrastructure. Human beings connect what happens in crypto with what happens in traditional markets. So even at the point where all of the connective tissue in the US went away, following Silicon Valley Bank, Signature, and Silvergate, we still had shocks going both directions. Whether that was you were an asset manager who happened to be holding crypto, which you now could not liquidate, so you were liquidating traditional assets, or if you were unfortunate enough to be impacted in your stablecoin reserve by calling into question the redeemability through no fault of your own other than the banking infrastructure, either way, human beings connect the way we deal with money. So trying to say, oh, it's stablecoins' fault, it's crypto's fault, it's the traditional bank's fault, it's the central bank's fault, none of that is productive because human beings link everything. But I do think there's a lesson in this question, which is that the exclusion, right, particularly those shocks of events, the exclusion of new business models and new assets from large balance sheet banks creates systemic risk. And what I mean by that is the regulatory posture in many markets strongly discourages large balance sheet banks from either banking crypto-related businesses or from participating in public chain and crypto assets. What this essentially means is it's a free pass for large balance sheet banks to not develop the skills, risk management capabilities and education and talent that they need to manage that risk. If we can imagine a new asset class, let's call it a new rare earth metal, right? And we said to all of the big balance sheet banks, actually, you all need to deal in this. What they would do is we'd go and find some geologists, do some research, write research, understand the risk, get mathematicians, build risk models, and then offer products to clients. And that's the way that would work. And if we all had a go at that, we would end up with a small amount of our business exposed to the asset class, and the same across the large balance sheet banks, defraying the risk across the regulated space. By discouraging your strong balance sheet banks, which act as a regulatory extension and an economic buffer, from participating in this asset class, many countries are seeing a high concentration of risk with smaller institutions, some of the non-bank institutions, which are not capacitized or skilled to be able to manage the risk effectively, which results in an overall systemic risk, which actually affects the big balance sheet banks more negatively. Yes. So that relationship we need to really look at in every single market.
Yeah, so I think it's back to accountability. And with that, Renee, it's your time to spin the wheel again.
Is that fast enough?
If you want to, you can spin the wheel again.
Oh, sweet.
Oh, you got a... Wait,
Nice,
she got a
another
piece of cake just now as well. Now we know who rigged the wheel.
This is what happens when you turn up to rehearsal.
This is definitely rigged against big banks.
Right.
Yeah.
So now we know. Okay, now we have a piece of cake question, and Carrie, also from our PZF alumni, has kindly provided a piece of cake question. How do you balance privacy expectations of the users of digital currencies with the need for transparency to prevent illicit activity, especially for cross-border trade? I was going to say, how is this a piece of cake?
This is not a piece of cake.
This is
not a piece of cake.
Someone miscategorized the question.
Maybe they knew Renee was going to answer. It's a piece of cake for
But
you.
Renee, you can handle this.
Yeah, you can handle it.
Time is yours.
I think this is a really important question for the stage of maturity we're at in terms of digital currency innovation across all forms of the ecosystem, whether that's the large banking-driven innovations, public chains, stablecoins, DeFi, all of this, we're up to this problem now, right? And actually what's interesting is that the privacy expectations vary dramatically from market to market. But a lot of the activity we still see today happens with intermediary institutions. So, for example, if you are conducting trading activity on a particular venue, that is not public. Maybe the settlement to your wallet is public. I think when we look at privacy protecting technologies, whether that's zero-knowledge proofs or other forms of privacy protection, when we look at what's happening in layer 2s and permissioning on layer 2s, I think there's a myriad of solutions. But I actually think there's a bigger question behind this, right? So the bigger question is, how do we get better at identity and projecting identity into large-scale public or large-scale permission networks? And the challenge we have today is we have many institutions who aggregate proofs of identity, hold those in a database, but with every time you interact with a new entity, you have to re-surrender all of that information. That complexity exists, and I think it's a problem for any institution that's aggregating KYC information to be working on how do we project that identity in a way that is privacy protecting. So in terms of how do we balance the privacy expectations and the need for transparency, in all of these, there is a way to unpick from a law enforcement construct. I think CBDCs, this is going to be one of the biggest topics, where we want a free and open economy to drive economic activity. We want to protect people's private spending habits, but we also want to interrupt bad actors within any single network. So I think there's definitely technologies that can help us balance that, but this is the work we need to be doing now.
Yeah, and I think this is a really complex governance and policy issue. But Dante, over to you for your views.
If I may, I think this is a great example of where banking, finance, payments, and public sector authorities could actually learn a lesson from telephony. When the mobile phone companies were competing fiercely, and you as end users were locked and your phone number was locked to the provider, and also, of course, the physical infrastructure of creating ubiquitous mobile telephony required lots of investments. Otherwise, fiercely competitive companies turned the telephone infrastructure itself into a shareware layer. And then the policy environment that encouraged portability of your phone number.
Yes.
And so I think if ever there were a space in which you will get virulent or potentially vehement agreement between the gentlemen on this panel, it is in a domain in which identity and the presumption of privacy should be features of financial access. And frankly, it's one of the world's biggest fears of retail central bank digital currencies is the notion of the people and the institutions who are delivering the service to me should not be endowed with a big red button that could potentially disempower people, disempower people or deplatform people from their money. And so privacy and trust are the core ingredients that fuel financial innovation, financial assets around the world. But it gets back to the central point. This should be the space in which there's cross-entity, public sector and private sector collaboration to create ubiquitous standards for financial portability that guard privacy. And the tech is the easy part. It's the ability to cooperate is the hard one.
I think Uma is about to agree with you.
I'm going to agree, because I think even before this new tech came around, we actually have tried going down this path multiple times. Because to Renee's point, even in standard BAU rails that Dante doesn't like, we have to go across various banks. Things touch multiple banks when they go from point A to point B. And at every stop, you're actually repeating the same activity, which is not only wasteful, but actually it could cause a lot of, sort of extra work for the clients, et cetera, et cetera. So many regulators are just not at a point where they are even willing to go with a certain standard and saying KYC is portable or identity is portable. In reality, I think what blockchain tech does is it takes it to the next level. We've been working on things like verifiable credentials and portability of identity for years. So this tech enables you to get to that point where we can have standards and you can go and we can rely on standards. And as long as the public domain, which would be regulators, are willing to be okay with a standard, then it shouldn't matter whether it's a bank or a non-bank, kind of fulfilling those standards. We can actually maintain privacy because you can have self-sovereign characteristics to the identity. And you don't need to know who I am, but you know that some institution, could be JP Morgan or SEB or Circle, met the standards of a regulator and said that I was okay for this transaction. So.
Yeah, and I think, Uma, you've hit the nail on the head that for a long while we've been talking about, portability or interoperability at a technical standard. But actually what we may need to move to now is on a policy and governance standard, portability and interoperability to get us to that next stage. And you have the final spin of the wheel.
Okay.
Now that you have the final spin, I was going to say...
I'm going to go fast. So
exactly.
Now we should go have a cup of coffee.
Move fast and break things.
Yeah, move fast.
Yes.
Break things. Okay.
And we have... it's full of suspense, this wheel.
See?
As
you
fate,
asked me to do the audience question
right.
at the end,
as fate will have it,
happy to oblige.
You are taking the Ask Me Anything question from the audience anyway. Well, this is creepy, Uma. But here we go from anonymous with 13 votes. That's quite a lot. Yeah. Are the big players truly innovating or just keeping up with each other's features? So copycatting.
Yeah.
Is this arms race delivering real benefits, or are we just adding complexity without adding value?
So there's a few questions there. First of all, I don't know if We're just keeping up because others are keeping up with us. So there's that. So we are innovating, and our peers keep up. So that's great. But I think there's very few players that are willing to invest amongst the big banks. And when I say big players, I'm taking the banking industry. There's very few players that have the ability, from a technology point of view, an investment point of view, to build a meaningful infrastructure. And especially given that we are primarily in permission worlds, for various reasons for now, you need to have the staying power and the investment to build a very big ecosystem within sort of your own space. So I think there isn't a keeping up type thing. I think there's 2 or 3 folks that are really driving this, and then hopefully others will sort of learn and come up. And I think it is delivering real benefits. If I look at our clients, we now have clients everywhere from large banks to to corporates, to actually government entities that are on our blockchain doing transactions, because they want to use the upside of the tech, but they are also not comfortable at this point going to the public ecosystem for various reasons. So I think from our point of view, we are delivering a lot of benefit. Just to give you one example, there's parts of the world that are actually open on the weekend when the Fed may be closed, and they need to do transactions. And so they use our infrastructure to do those transactions on the weekend, for instance.
Yeah, so this question about is innovation actually stagnating? I think that's a key feature of this particular question. Dante, Renee, any views on this?
If I may.
I defer.
Yeah. so there's no point keeping up if someone's going in the wrong direction, which is an important point. And I think that unfortunately, not everybody can be a JP Morgan customer. There is important parts of the communities that we serve as financial institutions, which we have to do a great job of including. And some of that's working through partners, and some of that's building infrastructure, and some of that's leveraging large-scale public infrastructure that's proven its resilience. So I think the answer is, I don't know a single big player that's not innovating and not trying to do the very best that they can for their customers and their shareholders and the community. But I do think, in many ways, it's hard at this early stage to recognise exactly where the value is going to come from. So the biggest challenge for all of us is to look back into the past of the evolution and innovation of financial services and imagine forward into what the world is going to look like, how these technologies might scale, where we might run into challenges with the existing models just adopting the technology and not necessarily keeping in mind that communities that we serve. So are we adding complexity? There's not been a point in history where we've had major innovation that has not added complexity. And part of the challenge of innovating and moving through a period of change is accepting the complexity, working through that, supporting the communities that we care about through that, and getting to the other side where we coalesce around the things that drive exponential value. We saw that with the internet, we saw that with early stage of computers, we saw that with the evolution of bearer instruments, which I've mentioned before today. All of these periods of change have added complexity, no question, but keeping in mind the communities that we serve and how we can best predict and support them into the future on the other side of that complexity is what has to be top of mind for every single one of us.
So complexity is a necessary ingredient of progress, you would say. Then, Dante, you have the last word on this.
Oh dear. So it's worth reflecting because it is a question that requires reflection. That when the Bitcoin white paper was first published and Bitcoin was born, traditional institutions, their first response was, I like blockchain, but I don't like Bitcoin. The second response was, I like blockchains, but I like the DLT kind that are closed and permission, to which I would remind people a Google spreadsheet on Amazon's cloud is not the same thing as openly, universally accessible infrastructure. The next wave of whataboutism was, I don't like stablecoins, but I like CBDCs. I don't like CBDCs, I like deposit tokens. I don't like deposit tokens, I like tokenized treasuries. And then eventually, we now land at a point in time in which, because of the value that this novel set of activities has actually introduced, and because like all early technologies, early flight was terrifying, early banking was terrifying, early crypto was absolutely terrifying. I've been uploading dollars on the internet for a while now. It's terrifying. But when it starts to work, we can no longer ignore it. We can rebrand it, we could do the Blu-ray DVD debate, but what people want and what markets want are outcomes. These are technologies that allow us to deliver outcomes that we cannot deliver if to be banked singularly hinges on brick and mortars. And if to be banked were only about iterative evolutionary innovations, we might have kept the checkbook around for a little too long. But a country like yours offers us a really good example, a glimpse into the future. But we will not be able to build a future in which everyone everywhere should have access to core human right levels of financial services unless we also allow calculated, rules-based innovation and risk-taking with technologies. Cloud computing was terrifying. And if you were the IT department, for your own job security, you clinged to your server farm like your job depended on it. But guess what would have died with your job? Your company, if you didn't allow your company to use the cloud. In the same way that your industry will also die and payments will also die unless we allow banks and non-banks in a rules-based way to take this early flight of the payments evolution. And so past is prologue, if you want to understand the future of money, but to stop us from innovating in the first place is largely what we have done. And I think the people and the entities that have paid the biggest price are actually the banks, because they're heavily regulated, and they should be, because their core function is trust.
Great. And on this note of innovation is key, which is very much central to the theme of the Singapore FinTech Festival, may I call up the leaderboard now for where your scores stand? Not from the audience. The audience gets to vote for, but where does the leaderboard stand? So, well, Renee, because you took piece of cake twice, you're now at 20, but there is a chance to catch up. Because can we show the QR for voting, please? For audience to vote for your favorite speaker, because we will aggregate the scores from there, and then we will have the results for best speaker of this session. Now, as they are doing that, and you have 2 minutes to key in, so please key in your choice. I would turn this to the speakers, beginning with Uma, and then Renee and Dante. Just a 1 minute closing, please, from each of you.
So first of all, I think we can debate all we like, but we fundamentally agree that at the end of the day, we need a rule-based system where everyone can not only operate, but interoperate.
Yep.
So there will be different layers of money. There might be a CBDC. There will be deposit tokens that players like JP Morgan and SCB will do. There will be things like stablecoin. There will be digital wallets like Grab and PayPal and all. The system needs to interoperate because it should be the consumer's choice as to what they want to use and for what purpose. So I think all I would say is that's what we need. We need a rules-based system, which is also, as hard as it is, somewhat globally consistent, because these, just like we bank all over the world, by definition, many of these techs are cross-border.
Yeah, indeed. And interoperability is the key to cross-border payments. Renee, your turn.
I guess I'd like to end on a note of optimism. So one of the great things about coming to Singapore FinTech Festival is that I get to spend time with the people that are working on these exact problems. I do agree with Umar. We want the policymakers, the regulators, and all of our ecosystem colleagues to come with us on that journey to make money better for everyone. The quality of people that are here sitting in the audience today, all of the people that I'm sharing the stage with, are some of the best minds on the planet being applied to solving these problems. And I think that's actually something that we should reflect on when we are thinking about policy decisions, when we're thinking about how we regulate, and we think about how we innovate. We should take some confidence and some positivity that we have a large number of people who care deeply about making money better and who are working together to improve that. And I think, in my experience, that's the vast majority of folks. And a much smaller group are perhaps looking to just self-serve and look after their own interests. So thank you all for coming today. And for those I've been able to spend time with, thanks for inspiring me.
That's so heartfelt. And you have the last word, Dante.
All right, well, I'm going to try to take the olive branch and end very positively. The only reason if I sound a little salty and I'm ready for a debate is I was expecting a fight here. So obviously, the truth is the future of money is already here. The challenge is it's not evenly distributed. And I think exactly in the spirit that Umar and Renee described it, it's upon all of us. It's upon the newly launched GFTN network that Singapore is driving to ensure that the future of money finally becomes more universally accessible and evenly distributed. Because I would remind everybody in this room, the first of the UN Sustainable Development Goals is to eradicate extreme poverty. How are we going to do that if billions of people are on the very edges of stuff that we all take for granted because we got to fly to Singapore? And so I think that's the thing that we should leave with. Nothing worth doing is worth doing alone, and innovating payments so that they're accessible, fast, cheap, and trusted is a job worth doing, and we should all try to do it together.
Nothing worth doing is worth doing alone, indeed, Dante. Put your hands together, please, for our fantastic panelists today. And at this time, in a kumbaya mode, could we please see who won your the best speaker? And the best speaker goes to Dante, second Uma, and then Renee. Please, could you come to the middle of the stage so I could give you your prizes?
Can we
Dante.
do Oprah Winfrey rules where
Everyone wins.
Of course,
Yeah.
everyone wins.
Thank you.
Thank you all so much for your enthusiastic, participation today. We have medals for the other two as well.
Okay.
We're all about that sharing.
I don't know.
you know.
What is that?
But thank you all. Thank you all for
gold
this.
or
I'm definitely bronze.
yeah.
Well, congratulations, Dante. You want to hold up that trophy? That looks amazing. Well done.